Welcome to this week's episode of the Move Smartly Show. Today, I had the pleasure of interviewing Jeremiah Shamess, who's the Executive Vice President at Colliers, a commercial real estate firm. And Jeremiah specializes in selling land, ideally for redevelopment. So think about the land that builders buy to build condominiums. He typically represents the sellers in those transactions. So it's a very good lens into how our new housing market has evolved over the past 10 to 15 years, what things were like leading up to the peak, and how things have changed over the past 2 or 3 years. So we talk about that, how land prices have changed. We talk about some of the factors that have led to this, what is probably an oversupply of micro condominiums in the Toronto area, and what he describes as a paradigm shift in what we're building and how we're building in Toronto, and how our new housing supply will evolve over the next 3 or 4 years. I hope you enjoy my interview today with Jeremiah Shamess. All right, Jeremiah, thank you so much for taking the time to join us on today's episode of the Move Smartly Show.
Oh, thanks for having me, John.
All right. So before we kind of kick off, I think we want to talk a lot about what you're seeing on the ground, talk a little bit about micro condos, everyone's favorite topic. What's going on with taxes on housing. That's a hot topic. But before we kind of dive into it, maybe you can kind of just give the listener or the viewer on YouTube a little bit of background about what you do, who your clients are, who you see, who you speak with, because I think it kind of gives them some context into sort of our discussion going forward.
No, I appreciate that, John. Thanks for having me on. So I lead the private capital group at Colliers, and specifically what I do is I represent owners of buildings and development land, and I represent in selling their properties. So this is mainly done through a number of different formats, but the easiest way to understand it is just we're a sell side advisor to commercial real estate owners in the greater Toronto area. Also, we do quite a bit in downtown Hamilton. The majority of my book has been development land, about 60% of it. The other, part of that has been office buildings, retail plazas, and apartment buildings. The last part of the bull market had development land being a greater proportion of that business, but now really that market has changed substantially. So now we're selling quite a few more building sales, like retail buildings, apartment buildings.
Mm-hmm. That's helpful. So, as we kind of go into the transition of your business, maybe you can kind of walk us through, what the market was like for development land. And by that, of course, we're talking about land that can be redeveloped for the most part for condos, I'm assuming. You do some low rise, but mainly condos, I believe, right?
Yep.
So maybe walk us through what the market was like, in the 10 years leading up to whatever the peak is, how things evolved, what you kind of were seeing on the ground, and what the dynamics were, I guess, over that time, and how things kind of evolved over that leading up to the peak.
It's a good question. One of the largest deals I ever did at about 10 years ago actually was a 60-acre subdivision land we sold to Mattamy Homes just west of Burlington in Waterdown. And if you look at the way parcels of low-rise land work, it's really more so that it's connected to what piece of land is within an urban boundary. So what actually has a direct line to actually getting developed. So I did quite a bit of work in the low-rise land market about 10 years ago. But at that time, I had started working through trying to understand where the redevelopment market was. And what I ended up doing was walking all the streets with binders, building out like exactly who the owners were and trying to understand, on King Street, on Queen Street, on Yonge Street, on Dundas Street, just where these owners of land could be parceled together to have something that was large enough to be developed. So we were always targeting 15,000 square feet of land at the time for this. We call it redevelopment land, but now it's just really been kind of blended into development land sales. And so about 10 years ago, you had a divergence from the low-rise market into the high-rise market, where you had a number of low-rise builders starting to understand exactly how can I get into this high-rise market, either by building mid-rise or building high-rise, because the low-rise deals take exceptionally long to actually get to market. I mean, the parcel of land I sold to Mattamy, for instance, since we're talking about that, that was something that was 20 years in the making. And then eventually they had an entire partnership that decided to sell, and 60 acres was, partially zoned, partially serviced, and partially unzoned. And that work had taken close to actually 7 years to get approved on that side, but they had owned it for 20 years and they had started a rezoning process almost 15 years before. So all these builders started to figure out, wait a second, we have this green belt that surrounds our city and we're coming up against limited farmland availability, greenfield land, in order to do ground related development. So not high rise, mid rise. So they started looking into the different, we call them infill areas, but development land areas within the city. So what happened in about 2014 to 2017 was kind of this slow ramp up to ultimately what I would call the first peak of the bull market in 2017. And within that time period, it was extremely hard to get builders to buy high-rise land pre-2014. So land that I had worked on, I still remember one of the largest developers in the city. They've built one of the largest high rises in the city in about 2013, saying, I don't want to buy any land downtown unless it's distressed. So there was a lot of people looking at the market saying, we really just don't want to do anything because it seems as though the market has peaked, which is, in retrospect, we kind of laugh now while we're looking at today's market. But from about Q4 in 2015 until about Q1 2018, the residential market, as you know, John, extremely well, just continued to move almost 3 to 4% per quarter, where it kind of culminated in 2017. And so, not to talk so much about the residential pre-construction market, but what that did is it kind of signified to the residential developer, I want to buy land and I want to try to find that land in some way, shape, or form. At the time, many of the developers were buying land unzoned, going to sell the condos with unzoned land and pre-approved land, and actually just getting their bonding on their deposits and then going to get their zoning, then going to get their construction. When you think about it today, it was a massive amount of risk, call it market risk, that people didn't really seem to care about. And by people, I mean residential developers. That changed very quickly in 2016 to 2017, when a few developers actually got caught in the start of an inflationary cycle for construction. But I'll give you an example of a land site I sold. So I sold a downtown corner in Toronto, downtown Toronto. And at the time, it was an unzoned parcels, kind of, we had targeted somewhere around a 20 to 30 story tower because zoning was less understood back then.
So let me just stop you. Let me just stop you here a second. So when you say unzoned for the average person, what you're saying is that it wasn't necessarily zoned for a 20 or 30 story high rise. Like they had to apply to get that, and there is some degree of uncertainty with respect to what the builder can get in terms of density. Is that kind of generally what you mean for the average?
Yeah, exactly. And yeah, that's a good point. I'm like talking to you like colleague here. In Toronto City zoning, they went through a number of different zoning changes, and most of the zoning in the city is either done in old City of Toronto bylaw or it's done in 1998 zoning bylaw. So most of the zoning was not updated for 20 years. Yeah. So you had instances where, and I'll give an example, in the entertainment district, so along Adelaide, when the allowable density along Adelaide would be like, say, 3 times density. And what happened in 2005, one developer tried to get a tower approved there. It took a little while, and he almost went bankrupt, brought someone in. But eventually in about 2007, he actually got a high rise approved there for about 15 times density. So you had overnight a zoning bylaw that had not changed, because we all know, our favorite city doesn't like to make a lot of decisions. They like to push these decisions off when it included zoning and transit. But that density overnight changed through this rezoning process to be extremely high from where it was in the past. So what this signaled to buyers of development land and condo developers is that you can kind of take any parcel and go at it as though you're going to create something that has never been done in that same neighborhood. So that catapulted some kind of change in how developers worked in the city of Toronto, and all the as of right zoning basically became I don't want to call it null and void, but basically became useless as some kind of a metric.
Interesting.
Because I remember early on in my career, I would talk to an owner of land and we would go out to market, and the developer would say, oh, well, it's zoned for 3 times density, so we can only sell it for say $5 million. And I'm trying to explain to them, no, we're going to represent you and we're going to get $15 million for this land, because you can actually multiply the density by roughly, let's call it 8 to 12 times. So early on in my career, I spent basically every single weekend and every weeknight reading city reports and planning reports, and became as knowledgeable as any planner in the city. Because at that time, we didn't really use a lot of architects to figure out how to do the planning. We had to estimate where the density was going to end up based on precedence, right? So just to explain to the listeners, no zoning was a real zoning until the developer went through the rezoning process. And back then, the developers actually would sometimes go out and sell condos for a building that was never approved and could actually be built before they even got their finalized zoning. So it was a very risky business. A few developers got caught and they got in trouble for it. So that process really didn't end up being kind of a long-term process. But for about 2010 to about 2014, you had quite a few trying to do that.
Yeah, that's amazing. I'm going to go on a tangent because you said a couple of things that I think are amazing for all the people who try to figure out what it takes to be successful. I mean, to me, you said several things that stand out. I mean, your story about walking the streets with a binder to figure out what can be developed, is the legwork that a lot of people just don't have the perseverance and drive to do. Your story about reading planning documents from the city of Toronto to be the expert that the seller needs, and educate them. Again, I think is the work that most people don't do. So anyways, hats off to you. I think these are great stories. I think when people think about the grind, like they look at someone like you successful, they don't think about how does someone gets to that point. But yeah, obviously it's a lot of the hustle that you put into to get there.
Takes a lot, yeah. I still have the binders, by the way.
So
right over there.
Where would you say was kind of sort of the, I mean, we have some thoughts on it, but kind of the peak of the development, or not the development, the desire for, buildable development lots in downtown, sort of in the condo market. We know the resale market peaked in first quarter of 2022, but where did things peak for developers? Because you obviously see things, way before a condo is completed, probably 8 years before, someone's buying the land, someone's planning it. So where would you say sort of the desire for condo development lots, that kind of market, when did that peak on your end?
Actually, nearly the same time as you had directed to. We sold a site that closed in April 2022 for $90 million downtown Toronto. And this site, we went to market in late, we went to market in Q1 2022, and we got a deal done in Q2 2022. And that was the peak of the market.
Mm-hmm.
The fact that we got that deal done was surprising, because there had already started to be a lot of, I would call it poise or kind of like caution in the market. And I remember it would be November 2021, we went to sell a piece of development land. It was a mid-rise site on the border of Etobicoke and Toronto. And we went out and we would do bid processes similar to, houses. how they did it, but we wouldn't price them. So I know with houses, you price them low and you expect high bids. We would just go out unpriced. Developers would ask us for guidance. We would give a range based on our underwriting where we thought it would end up. And, you would have kind of a mean, just like any standard deviation of the low and the high, and the majority being in the middle. And I remember at that time turning to my VP at the time and telling them, I think the party's over. And the reason I was saying that, because at the time you started to notice the conversations, like these anecdotes, buyers basically starting to tell you, I think we're going to be careful. The pricing just seems too much. And it had started in Q1 2021, but it didn't really show up in anything real until Q3, Q4 2021, and probably we didn't see anything on paper until 2021, till the end of 2021. But basically, offers came in, let's call it 15% off of where we thought they should come in. And so kind of overnight in that quarter, people started being cautious. We went to market with that other site. It was the downtown high-rise site, which is hard to find these sites. So we still had a lot of interest. But the pricing we were going after at the time was, let's just call it $300 a buildable foot. We ended up selling it for $263 a buildable foot, which still, was a very good price at the time. But most of the buyers in the market had started to underwrite close to $200 a foot. And now if you were to sell something in that same market, you would probably be close to $100. So you lost about 2/3 of value in certain areas in the city from the peak in 2022. Let's just call it May, April, somewhere around then to today. So pretty substantial change.
Wow, that's amazing. So, I mean, to unpack this a little bit for the average person, when we talk about, or when you talk about, the price per buildable foot, and correct me if I'm wrong, I'll try to explain it. Like this is generally how land is priced. Obviously, the more you can build, the more someone is willing to pay for that land. So, if you can build 100,000 square feet, you're going to get a certain price. If you can build 300,000 square feet, you're going to get 3 times the price. And the price is the price per buildable square foot, right? And
yeah, that's right. You're selling the future volume of the building you can build.
Yeah.
So if you've got, like, take this mug, for instance, I'm drinking some bone broth here. But say this mug, you get this parcel of land approved for a future building that's 100,000 square feet.
Yeah.
You price that zoning allowance, or in the case of an unzoned parcel, you price the future potential of that volume of building you can build. And we generally price it based on gross floor area, which is a zoning floor area, which is inside wall to inside wall.
Yeah. Okay. So, and sort of at the peak, you said $300 a square foot. Is that kind of a...
Yeah, in downtown West, that was basically the peak. Yeah. Okay. There was a parcel that sold for $290 a foot. And I put this on my Twitter at one point, where it was sold for $290 a foot. And then it sold last year in a distressed position for about 40% less. And today it would probably be about 60% less.
Wow.
So
okay. I mean,
the trough, it was significant.
So to unpack that for the average person, I mean, when the builders were paying, say, $300 a buildable foot, I mean, what they're basically looking at, and again, correct me if I'm wrong, they're basically saying, well, what can I sell this condo at? Let's just say it's $1,500 a square foot. What am I paying for land? What are my hard costs? What are my soft costs? What are my taxes? How much profit do I need? What's the max I'm willing to pay for that? Is that roughly kind of how they come, they basically work back to the land price by looking at their profit and their costs generally?
It's exactly right, John. We use what's called a residual land value, where we look at what the revenue is, whether it's rental or it's condo. You work backwards through your costs. And then obviously a profit is a cost as well. And then you look at what your ultimate end value is today. But a very important indication for those listening today, these financial models today, although they actually work today for rental and even on conservative assumptions in some areas, not everywhere, most buyers are not buying based on this model today. They're actually buying based on more of like let's call it a horse trading value. Mm-hmm. Because right now, buyers are in the driver's seat. So they can actually go out and look at a site, and they're able to negotiate based on what else is on the market, the competition of what land is being sold. So the
I
market
see.
has changed drastically from and I should just add one little asterisk to this. Every sophisticated developer is still running their financial model, but it's the market is less priced now based on what our financial model is telling us and more based on what is actually out in the market for sale and how much can I negotiate and what am I competing against. So
Yeah.
it's really changed pretty substantially.
But to some extent, at the end of the day, when you talk about like the, 60% decline, land values going from 300 to 100 bucks a square foot. I mean, part of that is driven by the fact that builders are looking at the resale market saying, well, I can't sell at X price. The decline in the prices that the, average buyers willing to pay, whether they're going to build a condo or not, is going to flow through to lower land prices effectively, right?
No, yeah, it's very true. I've got a state of the market here. I can maybe even pull it up. But like if you look at the development land market, like the peaks for the development land market happen on the exact same time as the peaks for the pre-construction condo market.
Hmm.
And the best way to think about it, John, is just if you're a developer, you maybe have more than one site in process at the same time. And if you are out there selling your condo site at Main and Main, and you've just sold 80% of your condos, then you're also being called by someone like me. And I'm saying, I have I have a parcel of land that's 3 blocks from Main and Main, and I'm going to sell that piece of land. Even though you've just sold the condos and you haven't constructed that site, your direct thought is, I need to buy another piece of land because I can sell these condos, right? So that condo market follows the development land market very closely because the mood and sentiment of the actual buyer of land, they're thinking about where do I get my revenue from? Even though you would assume that, because these projects take sometimes, depending on the size of the project, 3 to 7 years to complete, you'd think that you'd want to plan ahead. Well,
Yeah.
it doesn't always happen like that.
Hmm. Interesting. So we talked about the decline in land values. I mean, what are you seeing in the market now? Who is selling land? I mean, it is effectively people who need to sell, like they need to exit, they can't hold it. I mean, we're obviously hearing a lot about power of sales for resale homes. Are there some power sales in the land market? I mean, I'm sure there are. We've heard them, but what are you seeing kind of on the ground in that sense?
Yeah. Most, I would, you know what? I have not actually figured this out, but I think, roughly 65% of the development land mandates that we have to sell land are either a receivership process or a power of sale.
Hmm.
The difference between the two, just for everyone listening, is a receivership is just a court ordered sale to sell a parcel of land. So think of it like, um, you're captaining a ship, and the lender decides you're not a good captain anymore. So they want to come in, put their own captain on the ship, and have that captain sell the ship. So the lender goes out, they hire a receiver. The receiver then goes to the court. The court gets approved a sale process to then go out and liquidate the parcel of land. Then they go out and they come and they hire someone like me, and I go out and I sell this piece of land. A power of sale is when the lender is selling directly the piece of land. They have not gone to the courts and hired a receiver. The receivership is a more expensive process, but it's a more confirming process because you go through the courts when you're dealing with a whole bunch of complex things in title, and not to get too much in the weeds, but these are kind of the two basic forms of distress development land today. And the majority of the land we're selling today is distress. This year, there has been, in the city of Toronto, I mean, we don't need to talk about the 905. There's been about 8 high-rise development land parcels sold. I've sold 3 of them. They're not exactly that easy to sell. It's by far the hardest time in the market. And so a lot of what we're doing today is we're doing about 3 times the work to get to, the same outcome. And that involves a lot of just working through why the parcel actually works on a financial feasibility standpoint, and then why it may be a competitive site to buy. And today, 90% of the time, 95% of the time, builders are buying land in order to build rental. And so it's not like the market in the past where almost everyone was exclusively doing condo. It's only rental. Like, and I'll give you an example. Like, I've sold almost $2.2 billion worth of development land and buildings. In all those sales, I only did two development land parcels for rental in the previous market. I sold one parcel to Tricon, which is now Blackstone owned over by on Bloor West, and then one small parcel, a mid-rise parcel in Hamilton. So of everything I'd done, like rental was so rare. Now today it's completely flipped. The only condo development land you're going to sell today is either going to be in Summerhill, Yorkville, or maybe somewhere along Yonge Street. It has to be a very high-end kind of luxury product,
Mhm.
because otherwise you can't really sell condo today. It doesn't really exist anymore. And you know that better than anyone.
Interesting. So over the next 3, 4 years, you're kind of thinking the condo market or the new condo market, I should say, is largely on hold over the next 3, 4 years.
Well, less on hold and more so just very uncertain in terms of where the buyer comes from. I think in the future, and this is something you and I talked about it before we were recording. There's not really a lot of incentive to build a condo because you can't really pre-sell the condos. And I know you and I have had lots of, disagreements and discussions online, and I appreciate those arguments because they actually help us clarify and maybe crystallize what is exactly happening in the market. And it's that I don't actually blame the developers for these small, call it dog crate condos, the small project units that were built. I blame the entire market because the incentive to build those small units was set up by the banks and how the funding happened. And so, just to step one, have one step back. I think the only condo that will be built in the next market is going to be the developer who can actually go and build the building before selling it. So they're going to have extremely deep pockets, and it's going to be more end user product. So mid-rise building, something where I actually want to live in it, and it's going to be larger family oriented units because those are the type of people that actually buy when they see a completed unit in a nice neighborhood. So the entire market is going to flip from being these small investor driven condos to being end user condos. But even with that said, John, like, it could be on hold for 3, 4 years. You don't know. The luxury market, though, is still fairly strong considering. And I do have one client who I was actually talking to them earlier today, and they've actually had close to, I think it was 15 sales in a pre-construction setting. And we're talking a minimum buy of like $4 million. So a very, very large unit, high luxury type product right in, say, a high premium area of an established neighborhood. So that market just operates a little differently, not quite like the end user product.
I mean, and I mean, we had the news this week of Tridel basically canceling pretty much all the contracts at One Bloor, and converting them exactly to what you're saying, larger, higher end condominiums, trying to compete with, Four Seasons and so, but getting rid of or reducing the number of these micro investor units and targeting the end user. So, super interesting. Now, just to unpack a little bit about what you said about kind of the entire system, because I think it may have gone over people's heads on the micro condos. And I tend to agree with you. I mean, I think these arguments blaming builders are, I think, misguided. At the end of the day, builders have to build, they have a responsibility to their investors, and they have to build a certain way. And to your point, and we've talked about this, we build micro condos because Toronto and Canada in particular are one of these few countries where builders have to pre-sell what, 70% of their units, right?
Yeah, that's right.
And who's buying a home that they're going to live in but aren't going to get the keys for 5 to 8 years in the future? I mean,
Exactly.
it's not feasible, right? And so we depend on investors to buy them, whereas in a lot of other markets, to your point, the financing risk is carried by the builder and the bank. They build, like in New York, they build what they think end users want, and then they sell them, right? So very different financing model. And it sounds like you think this might be where, at least in the next little while, the types of developments we might be building, which, is probably going to be better because we're going to get more end user product. And the rental is going to be filled by the rental market, effectively purpose-built rentals.
Couldn't agree more. And that's why everyone gets angry at the developer for doing this. I mean, everyone is in business to make money. That is just ultimately the way things work. And I know Canada is maybe less happy with say the person making a profit than say the American model, where Americans kind of embellish this grind. Canada's a little more trying to spread it around and a little more socialist and liberal in nature, I guess. And there's nothing wrong with that. It's just that everything down to the clothes you wear, the car you drive has been built or created with a profit, right? And that's the developer. And they're thinking back in this old market, how do I actually get this thing built? Well, I have to pre-sell the units. And slowly but surely, John, you talked about what was happening 10 years ago. 10 years ago, I used to, with a friend of mine who is a real estate analyst, on the weekends and the nights, we would drive around and go to all these pre-construction sales condo centers because, at the time they weren't just selling these off plans online by platinum agents. You actually had to go into a sales center. So I remember one of the largest projects that was ever built in Liberty Village. It was a 3-tower, almost 1,100 unit project. They had a large sales center in Liberty Village. My friend and I, in a weekend, we would go in there. We get the sales pricing list, and then we would figure out what exactly they're selling the condos for. I would use that to then price land. He would use that to track the stats. But ultimately, it helped us understand exactly what was selling in the market. And so at the time, you would probably have somewhere, I'm trying to remember exactly, but it was roughly 50% investor, 50% end user.
Yeah.
Because at the time, I'll use my own experience, for instance. At the time, I couldn't afford to buy a house. And so I had to save up slowly in order to buy a project or buy a house. So I actually went and bought a pre-construction stacked townhouse project, and I bought it in 2015. I closed on it in 2019. But for me, at the time, I was trying to invest money and put it into other places. So I didn't want to take all this money and put it in and buy a house. So it allowed me to slowly save up and put a little bit of money towards it for 4 years. So for me, it worked well, but I was probably not the typical buyer. Most buyers were actually like, I want to buy a house. I want to see it today. I want to walk in the next 6 months for my family, right?
Yeah.
So back then it was 50-50, 50% end users, 50% investors. Slowly the developers started to learning the behavior of the investor and learning that the velocity of sales was better for the investor. And therefore they spent less time paying for land debt and more time getting the construction started and actually building it. So over time, which culminated in obviously like 2021, 2020, these buildings were sold 90, 95%, 100% investors.
Yeah.
And those were the ones who were actually pushing the deal to get it actually built. Because you could take a loan out against those deposits and you could actually build based on that. So that's just to happen. It was just a slow ramp up and watching the behavior of investors.
You're right. I mean, it didn't happen overnight. I mean, I remember, when I first got into the business, like every I didn't sell a lot of pre-com back then, but they were all end user buyers coincidentally. And they were a lot like you. They were younger, in some cases, like young couples planning to get married. They didn't need the home right away. I think back then we didn't have like 50-story condos. They were all, I would say, like what we would call mid-rise today, 12, 15 stories. So the construction cycle was a little bit shorter. And you're right, the share of end users versus investors has skyrocketed, obviously, over the past 5, 10 years. And builders are obviously going to build to, there's not just higher demand, but the investors were willing to pay more than the end users, the reality as well in many cases, right? So, yeah, so it's a gradual kind of evolution to where the market's going and where it ended. But I mean, obviously now it's stopped. I mean, it's almost like we had this run up, and it's very fascinating to see because, we went for this rapid velocity, this incredible acceleration, and then someone hit the brakes, the market hit the brakes, and now pre-con condos are virtually going to zero, right?
Yeah. I think in the last quarter there was 300 sales in the entire greater Golden Horseshoe.
Yeah. I mean,
And that's
exactly.
lower than the 90s. The
Yeah.
funny thing, John, I thought about this often, is the funny thing is that in the 90s, when the market did crash, some of the banks had to take over completed condo projects that had not been sold. And so they implemented this pre construction sales threshold to protect the banks. The funny thing is that the banks are really the ones who lent this behavior of developers to then ultimately sell to only investors and build, so little family size units that the city had to mandate 10% three bedrooms. Because, and not saying it's the bank's fault, but the bank was trying to be careful in saying we want to see revenue before we give you a large construction loan.
Hmm.
And so that kept our market from crashing for many, many years. Because if you think about it, the bank would not take as much risk on pre-funding, say, a $200 million construction project if they really were not certain about selling the units. And so those periods of time in, say, 2011 to 2013, there's a bit of a pause. 2018, there was a bit of a pause with the mortgage stress rules. Like these pauses, developers kept selling and kept buying land, right? Because you had to push to 70% sales. So the banks thought, hey, we're going to be safe because if the unit's not sold, we won't fund construction. So the market elongated its crash because of this, call it artificial control on getting projects completed,
Hmm.
to the point where now eventually the price discrepancy between pre-construction and resale ended up being this really big delta, this big bridge that ultimately, the pre-construction condo buyer said, you know what, the price is not worth it anymore. The interest rates have gone up. I can't carry my unit, so I'm going to stop buying. So that buyer pool disappeared overnight. And because of that, the market completely crashed. So in the banks trying to protect what they had done is really elongate the crash in that probably should have happened, say in 2008, 2009, or 2013,
Hmm.
but it never ended up happening. And so we just elongated this thing to the point where the breaking point happened because the affordability of the projects just wasn't there. It completely eroded.
Yeah, I mean it is amazing. I mean it kind of accelerated it. I mean the velocity increased in demand from investors, prices increased. I mean a lot of reasons why population's booming, all these things contributed to it, but you're right. We went to this space where the difference between pre-con prices and resale prices, I mean didn't really exist 15 years ago. Like there wasn't a premium. Over time we started paying, or investors started paying 40 to 50% more because they were just speculating effectively. I mean, that's kind of what I was seeing. No one really wanted to own them.
Yeah.
They just thought, I buy pre-con, I don't even take the keys, I flip it for 100 grand or 200 grand more before, right? So do you think that was avoidable? Like, do you think going to the financing model that, other countries have where banks take on the risk with the developer of the construction financing rather than offloading it to these mom and pop investors, do you think that's generally a better way to build condos at least?
Yeah, it's hard to say, John. I know that. So my cousin is down in the US and he funds a lot of these large projects. He runs an insurance company's real estate debt and equity book. And he always was just fascinated by the Toronto market, thought it should have crashed many times before. And the reason why is he said that in our market, we are a lot more careful with how we give a construction debt because we have to understand how do you actually get the money out at the end of the day, right? So Would that bring a lot more conservative underwriting into Toronto? Probably. But we know for certain that in these other markets, they still have booms and busts as well, right? So I think human nature is just that once something works once, it kind of, you let your guard down, you do it again. And, eventually there is a lot more speculation. Like you mentioned, speculation leads to the loss of fundamentals in the market, and the loss of fundamentals leads to a crack and a break and something that elicits some sort of crash, right? But I don't know. I think that in our current market today, given where banks are and how they underwrite things, that they're starting to underwrite rental. And rental is kind of the most conservative model for building. And if they can underwrite rental, that means that they're not getting pre-sales. It means that they have to understand what is a conservative estimation of what we can rent these units for. And we're going to give you a construction loan based on, let's call it 70% of that,
Yeah.
to 75% of that stabilized value, or loan to cost, we call it. And that's really how deals are getting done today. So I think in other markets, they just understand the end user condo market better.
Yeah.
Florida, for instance, just to give a little example of another market, you have a lot of Toronto developers going down to Florida now, and they have to pre-fund their subgrade, so they're underground. They have to fund about 10 to 20% of the start of the building, and then they're able to go out and get construction financing. So it's almost all cash for the
Wow.
first, call it 1/3 of the project.
Mm-hmm.
And then also, I'm told that pre-construction buyers in, say, a Florida market are a lot smarter to understand that we want to see the project completed or at least started before we're actually going to buy something. And we want to understand who is this developer and what is their financial backing. So, and that probably came out from the great financial crisis in Florida, right? Where they had lots of bankrupt sites. But this is my understanding today. It's mostly 30-40% cash to
Mm-hmm.
start these projects.
So way more capital intensive in the US for developers.
Yeah, very
Interesting.
much so.
So I mean, as we kind of approach the end here, what are your thoughts kind of over the next 2 or 3 years? What can we done to stimulate housing? I mean, of course, one of the big discussions is taxes, development charges, GST. Do we think, or do you think that's enough to drive more condominium construction over the months ahead, over the years ahead, I should say?
I don't think so right now. I think that the model is broken for condominium. I think unless it's very high end luxury, as I mentioned before, or maybe small mid rise boutique buildings, end user product, that may work. But and there are a few small ones I know that are actually going to complete the building first and sell. But other than that, I don't know where the condo market goes today. I'll be the first to profess that. But I do know one thing: the rental market is extremely well capable and healthy today as it relates to the absorption in the market. So one of the green spouts in the market is the fact that in the last quarter we had about 20,000. Actually, I'll tell you exact numbers. In the last quarter, there's 20,434 condo rental leases completed. The first half of the year, there was 30,951 condo rental leases. So we have basically in 3 quarters a monstrous amount of absorption of condo rental product. Now, people point to this and say, oh, rent is going down, it's the end of the world. I don't actually think that is as negative as maybe the media or online personalities would suggest. And the reason why is that in the last 6 months, there's been a record amount of supply completed, more than 22,000 units. So you have a record amount of supply, but you also have a record amount of condo rental leases completed. So that means anyone who owns a unit understands I can't sell it today, so I'm going to rent it.
Yeah.
So rent is down 4.5% this year. It's also down. It was also down last year, but it's still up from 2022, about 6.2%. And purpose-built rental units are still, you're probably getting about 2,000 units absorbed per quarter too.
Yeah.
So you have a monstrous amount of rental supply happening in our market. And to me, this is really directing the entire culture shift of the market to say, all right, I can't sell a unit. As a buyer, I don't really want to buy a unit. You know what? If I rent a unit, it's kind of pretty handy because I can sign a 1 year lease. I can decide to leave if I want. I don't have to be beholden to this mortgage. That money that I was going to put into a mortgage, I can go invest somewhere else. Maybe I can start a business. Maybe I can invest into a Canadian business. I can invest into equities. I can help out my family, whatever it is. So I actually am a huge proponent for rental product because I think it gives you just way more flexible options. And I think, most of the developers that end up still building in this market, I mean, many are disappearing, obviously, because there is sadly a lot of bankruptcies. And I know some cheer this on, but ultimately it's just a service-based industry. They're just people providing a service, they're building homes. And, you wish them well. But the people that do convert to actually build rental housing, they're actually going to be long-term providers of housing. And you have to build a building that you're going to sit and stare at for the next 20 years. You really think about which brick and which kitchen I put in and which toilet. So I think all the consumer has to understand this is good for the market. It's not a bad thing to rent. You have way more flexibility. I mean, until I bought that pre-construction project, I rented. I just moved from unit to unit to unit. And I tried out, I always laughed because I lived in 14 different neighborhoods in the city because it would allow me to study the neighborhood and, go walk around, find who owned the land. But it helped me understand that, wasn't beholden to this massive mortgage, right? I decided to buy eventually, right? Because I just wanted something a little more stable. But I really truly think that this rental market and this culture shift is not a bad thing. And the positive aspect of this market is that we are still absorbing a tremendous amount of this rental product. There's no sales, but there's a lot of absorption. I think that's a good thing.
Yeah, I agree with you. And listen, I think at the end of the day, over the next 3 years, I mean, we know we're not starting really any condos. We're starting very few houses. The only new supply that's going to hit the market 3, 4, 5 years from now is likely purpose-built rental. And I tend to agree with you. The builders who are building this are building better product than the condos, quite frankly. It is from my experience. I mean, we leased at a building across from our office owned by Hallmark. And when you walk through this building, it's on Larchmont and Queen. You're with the owners, and number one, it's a beautiful building.
It is. I know it very well.
Right? Like beautifully designed. All these, like you walk in and it smells like you're in a boutique hotel.
Yeah,
But
they have
even
the
at
scenting.
the scent, but even when you walk through the unit, like one of the guys from Hallmark's like obsessing about the layouts and like looking at the stoves. Like if I could have done it differently, I wouldn't have got these stoves. I don't like these. Like obsessing about every detail that I think is missed when you're selling these weird floor plans to investors who couldn't care less because they just want to flip it. These are, like you said, they're owners who are going to be looking at a property for a long time, needs to rent it out, are very invested in kind of the community and the culture. And many of the people who we're leasing it out to are actually referrals from tenants who live in the building, who like the building and want their friends to move in. So yeah, I do think it's a super positive development. And they're the only ones who are going to be bringing supply to the market. So it is a super positive.
There's zero condo finishes in 2029 at this point, according to one of the stats companies.
Yeah,
I mean, it's going to change drastically. And yeah. I'll say one more thing of contention too. There's a lot of people online that are talking about how all these condo projects are being converted to rental, and the rental market's just going to, take up all the supply and crash again. There's one thing that people forget. And for a rental project, you are required to put down a substantial amount of covenant. And that means you have to guarantee the construction loan. And I'll tell you right now, it is the biggest problem I'm dealing with because I'm doing a lot of joint ventures and equity raising for these developers who then have to do a rental project, and they don't have enough guarantee. Their partners don't have enough guarantee to go out to the bank and say, hey, we can guarantee 50, 60% of the construction loan. And so a lot of these projects are not going to get built. Even though there's enough cash to start them, you need that covenant. And so I don't think people realize how hard it is to build a rental building. And I don't think they understand how much of this supply is not actually going to convert. And I
Yeah.
would guess something about maybe a quarter to 30% will convert to rental projects because of this problem with covenant. Because and this is also a good thing for the market. If you build a rental building and you do put your guarantee and your covenant down, you have to wait till that building is completed, finished, and stabilized to then be able to go back to the bank again and say, okay, now I can build another one and
Yeah.
put covenant down. So
Yeah.
it's another reason that the rental market is a very good thing. It does not allow developers to go out and speculate on all kinds of different sites and have 7 sites in process. You can only build what you can guarantee. And so I think ultimately, this is a paradigm shift of the Toronto and the greater Golden Horseshoe market to where people are just going to rent. They're going to choose not to buy, but they're going to be less beholden to a mortgage. They're going to be more flexible to say, I got a new job. I can move across town. I don't have a mortgage, right? It's just much better. And that's why when you look at the US market, you realize that you see all this movement around the US from, say, someone who has a job in Austin, Texas, they get a job in Florida, or they get a job in Seattle. They move around because the US, 80% of the new construction market there is all rental. So they've already been doing it for years. And, I think that's something that Toronto, Canada is going to continue to do. And I think it's healthy for the market.
Yeah, absolutely. Well, Jeremiah, on that note, I want to thank you for taking the time for joining us today and sharing your thoughts on the condo market and, as you describe it, the paradigm shift that we're going to be looking at over the next 3, 4 years.
No, thanks very much, John. And, I appreciate being on, having this good discussion after our online
Yeah, for sure.
discussion. So, yeah, thank you.